In 2025, India absorbed 25% of total global silver supply in a single year. Not 5%, not 10%, 25%. And they did it while prices were rising sharply, which is the opposite of how India has always behaved in commodity markets. India is the country that walks away when prices get high, not this time. Silver hit $70 per troy ounce on COMEX by the end of 2025. That is a 140% rally in 12 months. London ran out of movable silver, delivery timelines broke down, cargo aircraft were rerouted to carry silver bars because sea freight was too slow to meet settlement obligations. And this month, China sealed its export border on the metal entirely. It seems like a commodity story. Just another precious metal having a moment, right? Except it is not. What is actually happening here is the quiet dismantling of the dollar-based pricing system that has controlled global silver markets since the 1970s, and the numbers show it is moving faster than anyone predicted. Let me show you what is actually happening here. I'm Mike. I use data analysis to spot patterns in geopolitics and economics, and this one is worth paying close attention to. Before we get into the mechanism, let us establish the baseline. Silver has spiked to genuinely historic levels exactly 3 times in the past 50 years. January 1980. The Hunt brothers accumulated nearly 1/3 of the world's above-ground silver supply, attempting to corner the entire market. Prices hit $50 per ounce. Then regulators changed the rules overnight and the whole structure collapsed. April 2011. The U.S. debt ceiling crisis rattled global confidence in fiat currencies. Investors fled to real assets. Silver touched $50 again before selling off sharply once the political panic faded. And then 2025. Silver closed the year at $70 per troy ounce on COMEX. Here is what separates 2025 from those 2 earlier episodes. In 1980, one family manufactured the spike artificially and regulators dismantled it. In 2011, investor sentiment drove the rally and sentiment reversed. In both cases, the underlying physical supply chain was fine. The problem was financial, not physical. 2025 was different. There was no single actor manipulating supply. There was no narrative that could simply reverse. What happened was structural. The world ran out of silver that could actually be moved to where it was needed. And India was the primary reason why. You could call it a commodity bull market. You could also call it the moment the physical silver system stopped being able to pretend the paper system was real. Both would be accurate. Let's talk about the mechanism here because this is where the pattern becomes visible. India is historically the world's largest consumer of silver by volume. It uses roughly 4,000 metric tons per year under normal conditions. Jewelry, religious items, industrial manufacturing. About 80% of that supply is imported, traditionally from the United Kingdom and increasingly from the UAE and China. Then 2025 happened, and 3 forces collided at exactly the same moment. First, India had an exceptionally strong monsoon season. For a country where roughly 55% of the population is tied to agriculture in some form, a good harvest means one specific thing: cash flows into rural hands. And in rural India, that cash does not go into stock market apps. It goes into tangible assets, things that can be held, stored, and passed to the next generation. Silver sits at the center of that tradition. It is affordable where gold is not. It is trusted where paper assets are not. It is what a farmer buys when he has surplus income and wants to preserve it. Second, gold had become genuinely expensive by mid-2025. Gold was trading above $3,000 per ounce internationally. In rupee terms, it had hit record levels. Indian gold buyers pulled back. And when Indian buyers pivot away from gold, they do not sit on cash. They move to silver. Third, and here is what most analysts missed. When they were covering this, India's retail silver ETF market had reached maturity. Indian retail investors were no longer just buying coins and jewelry. They were buying silver through exchange-traded funds at a scale the market had never seen before. And that distinction changes everything. When someone buys silver jewelry, that metal circulates. Jewelry gets sold, melted, refined, and reused. It stays in motion. But when retail investors buy silver ETFs, that metal goes into a vault and does not move. It is immobilized. And Indian retail investors tend to hold, not trade. So silver flowing into India through ETFs was leaving the global supply pool with no visible return date. Watch what happens when you line up those 3 forces together. A harvest income windfall hitting rural markets, a gold price that pushed buyers towards silver, and an ETF structure that permanently immobilized whatever silver it absorbed. India consumed 6,000 metric tons in 2025. That is 190 million ounces. That is 25% of total global annual supply, purchased by one country, in 1 year, while prices went up, not down. The global silver market was not built to handle that, and it showed. Now let's look at the supply backdrop because the India story lands on top of a foundation that was already crumbling. The silver market has been running consecutive annual deficits since 2021, 4 years in a row. The World Silver Survey data shows that between 2021 and 2024, the global silver market consumed 678 million ounces more than it produced. That is the equivalent of roughly 10 months of total global mine output, permanently consumed in 4 years. Let me put that another way. The world has been spending its silver savings account every single year since 2021, and the withdrawals are accelerating. The 2024 deficit alone was 148.9 million ounces. Industrial demand that year hit a record 680.5 million ounces, while global mine production held at around 816 million ounces. The 2025 deficit is estimated at approximately 230 million ounces. That is a larger single-year gap than any prior year in this run. Cumulative deficits since 2021 have now exceeded 800 million ounces. And the supply side cannot respond. Here is the structural problem. Global silver mine output declined 7% since 2016. Most silver in the world is not produced by dedicated silver mines. It comes as a byproduct of copper and zinc mining. When those producers adjust output for their own reasons, silver production adjusts with them regardless of what the silver price is doing. New dedicated silver mining operations take 6 to 12 years from discovery to first production. A price spike today cannot create new supply before 2031 at the earliest. Recycling fills some of the gap. But unlike gold, where recycling supplies roughly 25 to 30% of annual demand, silver recycling contributes only 15 to 18%. The reason is that most industrial silver consumption is permanent. Silver inside a solar panel, a circuit board, or a medical device is consumed. It does not come back. The above-ground supply gets permanently thinner with every unit manufactured. If you have any background in supply chain analysis, the structural picture here jumps out immediately. The supply side is inelastic and slow. The demand side is structural and accelerating, and the buffer stock built up over decades is being consumed at a rate the market has never seen before. The Silver Institute projects the annual deficit will reach 200 million ounces by 2030 if current trends continue. We are already running close to that. Now let's get specific about what happened to the physical market, because this is where the stress became visible in real time, and the signals were unmistakable if you knew where to look. London is the center of global silver settlement. The London Bullion Market Association tracks silver held in its member vaults. In June 2022, those vaults held close to 31,000 metric tons of silver. By March 2025, that figure had fallen to around 22,000 metric tons. That is a decline of roughly 9,000 metric tons removed from the London system in under 3 years. But here is what the headline number conceals. A significant portion of the silver remaining in London vaults is allocated. That means it is specifically earmarked for ETFs and institutional accounts. It cannot be used to fulfill spot delivery obligations. It cannot be loaned to traders who need physical metal. The silver technically exists, but it cannot move. Bullion market participants reporting from the October 2025 squeeze described a situation where there was effectively no unallocated silver left readily available in London at normal cost. Some deliveries were reportedly being rerouted by air rather than sea to meet settlement timelines. Think about that for a second. Cargo aircraft carrying silver bars because sea freight was too slow. That is not a commodity market operating normally. That is a market in physical distress. Borrowing rates confirmed everything. At the peak of the October 2025 squeeze, overnight silver borrowing rates reached an annualized 200%. That number is not a temporary liquidity issue. That is a market signaling that physical silver is genuinely scarce and the system is under real strain. COMEX in New York told the same story from a different angle. By February 2026, COMEX silver inventory stood at 376.4 million ounces, with a coverage ratio of just 56.3% against open interest. Open interest in COMEX silver futures fell by more than 22% between August and October 2025. Short sellers were being forced to unwind positions before delivery because they could not locate physical silver to honor their contracts at any reasonable cost. When short sellers cannot source the metal they committed to deliver, they have two options: pay a massive premium to exit the position early, or push the market into a settlement crisis. The 22% collapse in open interest tells you exactly which choice they made. They paid the premium and ran. Physically backed silver ETFs absorbed 134 million ounces globally in 2025. Those holdings reached a total valuation of $40 billion by mid-year. Every ounce absorbed by an ETF is one fewer ounce available for industrial delivery or market settlement. The ETF boom and the physical squeeze were not separate stories. They were the same story. Here's where it gets interesting, because a policy decision made in Washington in April 2025 accidentally made everything significantly worse. The Trump administration announced sweeping tariffs on Liberation Day. Gold and platinum were explicitly exempted, classified as essential to the U.S. financial system. Silver was not exempted. It was treated as an ordinary industrial metal and subjected to the standard tariff schedule. The immediate market reaction was counterintuitive. Gold spiked on safe haven demand. Silver dipped. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, surged above 100. Historically, when that ratio moves above 80, it has consistently preceded periods where silver dramatically outperforms gold. But something more consequential happened underneath that price move. Financial institutions and industrial buyers holding silver inventories became reluctant to ship that metal across borders. The concern was that silver exported from the United States might return subject to tariffs of 25 to 35%. Risk managers decided it was safer to hold the metal in place. Metal stopped moving, circulation slowed across the global system, and tightness in markets that were already stressed increased further. Washington did not intend to create a silver crisis. They were not thinking about silver at all, but by treating it differently from gold, they signaled to the market that silver was not a monetary asset. And by creating uncertainty around cross-border flows, they froze the very circulation the market needed to keep functioning. By the end of 2025, the gold-to-silver ratio had compressed from above 100 back down towards 60. That compression represents silver outperforming gold by roughly 40 percentage points in a matter of months. That is not a sentiment rally. That is a physical market repricing around real scarcity. Then China moved. On January 1, 2026, Beijing implemented strict new export controls on silver. The measures require exporters to obtain detailed government permission for any silver shipment leaving China, including declarations of end use and final destination. The structure mirrors exactly the controls China previously applied to rare earth elements. And here is what analysts usually miss when they cover this. It is not an outright ban. It is something more precise and more effective than an outright ban. When China signals that it may exercise discretion over export approvals, traders and industrial buyers do not wait to find out whether any specific shipment will be approved. They adjust behavior immediately. They reduce dependence on Chinese-sourced material. They hold larger buffer stocks. All of those behavioral changes pull metal off the global market simultaneously. Silver is becoming what rare earths already are, a strategic material that can be rationed by policy. If you want to sharpen your ability to spot these structural shifts before they become headlines, check out my book, Awake: The Practice of Critical Thinking in an Age of Soft Lies. It is designed to improve critical thinking around exactly these kinds of patterns. It is available in ebook and audiobook. Subscribers get 10% off, and you can grab the first chapter for free in the description links below. Now let's talk about the demand side, because this is the foundation underneath everything else. And it is why the supply deficit cannot resolve over any near-term time frame regardless of what price does. Silver is the most electrically conductive metal on Earth. That single physical property has placed it at the center of every major technology transition happening simultaneously right now. Solar panels. Every solar panel manufactured requires silver paste to conduct the electricity generated by its photovoltaic cells. As global solar capacity has expanded at record pace, silver consumption in solar alone has grown 51% since 2016. Solar manufacturers will not reduce orders because silver is expensive. They will pay whatever silver costs because the alternative is not building the panels. Electric vehicles. An EV uses roughly double the silver of a conventional petrol car. Each vehicle requires 25 to 50 grams of silver for contacts, switches, and power electronics. Global EV production is rising sharply through 2026 and beyond. 5G infrastructure. Each 5G base station consumes 15 to 25 grams of silver. the global build-out is nowhere near complete. Hundreds of thousands of additional stations are being deployed annually across Asia, Europe, and North America. AI data centers. The computing systems running modern AI models rely on silver-based components for high-speed signal transmission and thermal management. AI infrastructure investment is accelerating globally. Every dollar of AI capital spending brings incremental silver demand. Watch what happens when we line up those demand sources with the production numbers. Electrical and electronics demand for silver reached 460.5 million ounces in 2024. In 2020, that figure was 321.4 million ounces. That is a 43% increase in industrial consumption in 4 years. And industrial silver is not recyclable in any practical sense. Once it is inside a solar panel or a circuit board, it is permanently consumed. The above-ground supply gets structurally smaller with every unit manufactured. And consider this, the Indian government removed the import duty on silver in 2024 specifically to support the country's solar panel manufacturing sector. That was not a coincidence. That was state-backed industrial policy accelerating the very buying surge that drained global vaults. India's silver demand is not just cultural tradition or retail sentiment anymore. It is embedded in government manufacturing strategy. Now let me tell you what all of this means for the dollar-based metals pricing system, because this is the part of the story most coverage avoids entirely. The COMEX futures market in New York and the LBMA in London are the dominant global mechanism for silver price discovery. They operate on a model where the volume of paper contracts, futures, options, and forward agreements is vastly larger than the volume of physical metal that changes hands on any given day. Most silver trades settle in cash. Physical delivery is the exception. That model functions correctly as long as the paper price and the physical price track each other closely. When they diverge, the paper market is no longer accurately reflecting the real cost of obtaining physical silver. And here is what the 2025 squeeze revealed. That divergence can happen fast and visibly. Lease rates hit 39%. Overnight borrowing rates hit 200% annualized. Deliveries were rerouted by air. Short sellers paid extraordinary premiums to exit positions rather than attempt physical delivery. Each of those signals is the market telling you the paper price is not the real price. The real price is whatever it costs to get physical silver right now to wherever it needs to be. And that price was dramatically higher than what COMEX futures were showing. When the paper system and the physical system diverge at that scale, there are only two ways it resolves. Either the paper system adapts and prices reset permanently higher to reflect genuine scarcity, or the paper system fractures under delivery stress and loses its role as the global price-setting mechanism. Both outcomes are bad for the dollar-based metals framework that the United States has benefited from since the 1970s. The dollar's influence over commodity pricing is not just about oil. It extends to every major commodity priced in dollars on US-based exchanges. If silver's price discovery mechanism is fracturing under physical stress, that is one more layer of the dollar architecture eroding, quietly, structurally, in a way that cannot simply be reversed by policy. And consider the knock-on effects. Transaction data, settlement flows, and market visibility over commodity behavior all run through dollar-based infrastructure. When physical silver starts pricing itself outside of that infrastructure, it is not just a market event. It is a reduction in the systemic reach of the dollar system itself. COMEX and the LBMA cannot compete on physical delivery when delivery is the one thing the market cannot provide. They cannot restore confidence in paper silver when the paper-to-physical divergence has already been visible to the entire market. They cannot reverse what India and China have already done to the circulation of the metal. Here is my read on where this heads next. The silver market in 2026 is operating with its sixth consecutive annual deficit. Global supply is forecast to reach 1.05 billion ounces in 2026, an increase of 1.5% over 2025. Mine production is expected to reach around 820 million ounces, up 1% from the prior year. Investment demand in India is projected to continue building on last year's substantial gains. The deficit will persist. It will probably widen. COMEX coverage ratios are already at stress levels. A 56.3% coverage ratio against open interest as of February 2026 means the exchange cannot fulfill physical delivery obligations if a significant percentage of futures holders request them simultaneously. That is not a theoretical scenario. That is the current operating condition of the exchange. By late 2026, I expect one of two things: either a forced repricing of silver that genuinely reflects physical scarcity, meaning substantially higher prices than current levels, or a delivery stress event on COMEX that triggers cash settlement, where the exchange pays holders in dollars instead of silver bars. Cash settlement events destroy confidence in the paper market permanently. Both outcomes are bad for the dollar-based metals framework. The gold-to-silver ratio currently sits around 63 to 1. Historically, when that ratio is above 60, silver has outperformed gold over the following 12 to 24 months with high reliability. Motilal Oswal Financial Services forecasts COMEX silver reaching $75 per ounce in 2026, with potential for the $70 to $77 range by 2027. The bullish scenario, where the ratio compresses toward the historically observed 15 to 20 range, implies silver above $100 per ounce at current gold prices. In India, silver prices went from roughly 80,000 to 85,000 rupees per kilogram in early 2025 to above 2.43 lakh rupees per kilogram by January 2026, nearly a tripling in rupee terms in 12 months, and they are still buying. Here is the framing that ties all of this together. Silver became a strategic material before the world agreed to call it one. Demand became embedded in long-term industrial decisions that cannot reverse quickly. India immobilized enormous quantities through ETF investment. China added friction at its export border using the same playbook it ran on rare earths. And the paper pricing system in New York began showing visible signs of disconnection from physical reality in London and Mumbai. Once again, none of this is financial advice. Please do not make any investment decisions based on this video. This is data analysis and education only. Right now, watch the video on screen about how foreign central banks dumped $82 billion in U.S. treasuries in a single month. Because the treasury story, the silver story, and the payment rail story are not separate. They are symptoms of the same structural shift. The dollar-based financial architecture is eroding. Silver is one of the assets where you can see that most clearly right now. And 2026 is the year the numbers stop being deniable. Thank you all so much for watching. Subscribe, and I will see you in the next one.